Good evening and welcome everyone. We are here to discuss PNB Housing Finance fourth quarter and financial year 2017-18 results. With me, we have our leadership team represented by Mr. Sanjay Gupta, Managing Director, Mr. Shaji Varghese, Executive Director Business Development, Mr. Ajay Gupta, Executive Director Risk Management, Mr. Nitan Desai, Chief Operations and Technology Officer, Mr. Anshul Bhargava, Chief People Officer, Mr. Sanjay Jain, Company Secretary and Head Compliance, and Mr. Kapish Jain, Chief Financial Officer. We will begin this call with an overview and performance update by the Managing Director, followed by an interactive Q&A session. Please note, this call may contain forward-looking statements which exemplify our judgment and future expectations concerning the development of our business. These forward-looking statements involve uncertainties that may cause actual development and results to differ materially from our expectations. PNB Housing Finance undertakes no obligation to publicly revise any forward-looking statement to reflect future events or circumstances. A detailed disclaimer is on slide 2 of the investor presentation available on our website. With that, I will now hand over the call to Mr. Sanjay Gupta. Over to you, sir.
Thank you, Deepika. Good evening, everyone. We welcome you all to our Quarter 4 and Financial Year 2017-18 earnings call. The Financial Year 2017-18 is our first full year results declared post the IPO. We take this opportunity to thank all our stakeholders for their support and faith in our way of doing business. During the year, both our loan assets and borrowings crossed 50,000 crores rupees and deposits crossed the 10,000 crore rupees. On the borrowing side, while maintaining a fairly diversified borrowing mix, we also set up a $1 billion MTN to raise funds via rupee-denominated masala bonds, where IFC Washington, D.C. is an anchor investor with a commitment of $150 million. With our continuous focus on people, processes, and technology, we initiated a number of digital solutions like digitization of customer security portfolio documents, intelligent mass mailing solution, e-verification of various credit checks for better quality, faster execution, and superior customer service, and improving overall efficiency in our operations. Let me now start with the financial performance of the company. The figures are consolidated financials compared with the previous financial year. Financial year 2017-18 registered a healthy double-digit growth. The net interest income was up by 54% at 1,593 crores, and profit after tax was up by 58% to 829 crores. The spread on loans for financial year 17-18 is 2.36%, and net interest margin is 3.07%. The cost of borrowing declined by 84 basis points to 7.71% during the financial year 17-18. In line with our focus on costs, the OPEX to average total assets for the current financial year is at 68 basis points compared to 73 basis points in the financial year 2016-17. This is notwithstanding the fact that with our ongoing branch network expansion, the cost undertaken also includes growth expenditure. If we only consider our business as usual, BAU as we call, the OPEX to ATA further drops to 61 basis points. Our cost to income ratio declined to 19.54% during the financial year 17-18 vis-a-vis 22.43% in the previous financial year, a reduction of close to 300 basis points. The return on assets for the financial year 17-18 is 154 basis points. The return on equity is 14% for 17-18 vis-a-vis 14.92% for financial year 16-17. The decline in the ROE is due to expansion in the equity capital post our IPO in November of 2016, with average gearing of 7.6 times during the financial year 17-18 vis-a-vis 8.72 times during 16-17. The board recommended a final dividend of rupees 9 per equity share of 10 rupees for the financial year. Let me now talk about our business performance. During the financial year 17-18, we registered 54% increase in the loan file logins compared to the previous financial year. The disbursements registered 61% growth for year-on-year at 33,195 crores vis-a-vis 20,639 crores during the previous financial year. The disbursement towards individual housing loans accounted for 53%, construction finance 16%, and non-housing loans at 31%. The assets under management registered a growth of 50% to 62,252 crores as on 31st March 2018. Geographically, West is our largest market with 39% of AUM, followed by North at 32 and South at 29 of assets under management. We have limited presence in East with only 2 branches, one in Calcutta and the other one in Bhubaneswar, which forms a part of the North Zone. The company sold loans worth 3,128 crores under direct assignment route during the financial year 17-18, and the total outstanding loans assigned amounts to 5,238 crores as of 31st March 2018. Net of this securitized amount, the loan assets and books are 57,014 crores as on 31st March 2018, representing a growth of 48% year-on-year. Housing loan constitutes 70% of the loan assets outstanding, and non-housing loans constitute the balance 30%. In the housing loan segment, individual housing loans constitute 56.2% and construction finance constitutes 13.6% of the loan assets. In the non-housing segment, LAP, that is loan against property, constitutes 17% of the loan assets. Lease rental discounting and non-residential premises loans and corporate term loans constitute the balance. As a part of our geographical expansion plan, 21 new branches were made operational during the financial year 17-18, totaling to 84 branches with presence in 47 unique cities. The company also services its customers through 34 outreach locations. The company has operationalized 3 hubs in 17-18, totaling to 21 underwriting hubs as on 31st March 2018, catering to the branches and the outreach centers. During the year 17-18, out of the total individual housing loan disbursements, around 22% by value was in the less than 25 lakh segment, which can be termed as affordable housing segment. With increase in our branch network in Tier 2 and Tier 3 cities, we look forward to increase the contribution of the said affordable segment in our individual housing loan portfolio. Part of this portfolio also qualifies as priority sector lending, PSL, which can be sold off to banks at clearly attractive price in the future. The gross NPAs as a percentage of loan assets is at 0.33% as on 31st March 2018 against 0.22% as on 31st March 2017. The GNPA or the gross non-performing assets for housing loans is at 0.35% and non-housing loan is at 0.27% of the loan assets. The gross NPA to AUM level is 0.31% as on 31st of March 2018. The lower gross non-performing assets is a testimony of our robust underwriting processes. We have specialized teams for credit underwriting, verifications, fraud control, legal and technical fluctuations, which is complemented by a dedicated in-house collections team. Loans are underwritten on predictable and consistent income streams supported by income and bank documents. We have a strong portfolio monitoring mechanism, which further helps us in detecting early warning signals. In wholesale finance, we have stringent norms for customer and collateral underwriting. There is a specialized and dedicated team for this business line, while the functions like underwriting, technical, legal, operations, and monitoring is centralized. The relationship team is spread across various large geographies and cities. For these proposals, with the developer's credentials, financial standing and previous track record, we also do an in-depth study of the micro market, targeted segment, etc. Developer ratings, their equity in the project, stage of project, sales and collection velocity, etc. are other important vectors which are considered before extending such facilities. As widely reported, much to my surprise, there are instances of developers defaulting in their commitments. In wholesale finance, fortunately, we are not impacted by this. We have no corporate exposure today or in the past to developers like JP, Amrapali, Parasnath, SRS, ERA, Earth, etc. We have no corporate exposure to Unitech or any of its group companies either. The stock of acquired properties as of 31st March 2018 stand at rupees 179 crores against 155 crores as of 31st March 2017. Our collections philosophy is to cure and not just collect through legal channels. The company uses SARFAESI very effectively, and we are working towards reducing the stock of acquired properties. Our total borrowings as on 31st March 2018 stood at 54,268 crores. The company has a diversified borrowing mix with 42% contributed by non-convertible debentures, 21% by deposits, and 19% by commercial paper, 9% banks, and 7% as refinance from National Housing Bank, and the remaining through ECBs. NHB reposed its confidence on us as we raised funds to the tune of 1,500 crores during Q4 of the financial year 17-18. This is a long-term funding raised for a period of 10 years. During the fourth quarter, we securitized 3,128 crores to 4 institutions at very attractive price. We would continue to explore this avenue and look for opportunities to have a positive impact on our borrowing costs. Considering the ongoing volatility in the market, we anticipated liquidity issues in the short term and hence maintained excess liquidity of around 1,500 crores. The current investment, cash and bank balances as on 31st March 2018 is 4,035 crores. This also includes the proceeds which we got from our securitized pool. The capital adequacy ratio as on 31st March 2018 stood at 16.69%, of which Tier 1 capital is 12.77% and Tier 2 capital is at 3.92%. In line with our philosophy to enable the not-so-fortunate segment of the society in becoming capable and self-reliant, we work in the area of skill enhancement trainings, daycare centers, education and healthcare under our corporate social responsibility program, which we like to call it as Saksham. During the year, we touched 15,000 lives through various programs and are committed towards it in a substantial manner and in a sustained manner. We are a strong 1,290 full-time employee team as of 31st March 2018. We have registered an increase in all the employee efficiency vectors like disbursement per employee, loan assets per employee, revenue per employee, and profit after tax per employee during the financial year. Before you ask questions, would like to mention that the company promoted by Punjab National Bank, PNB, shares a common brand, yet as per the regulatory stipulation, maintains an arm's length relationship with PNB and does not leverage the promoter for any business or resource mobilization. This is further validated by the rating agencies post the recent fraud issue reported by PNB in February of 2018. The rating agencies report their confidence in us. Both CRISIL and ICRA have come out with a credit bulletin within a week stating that the incident has no impact on the company's business and financial risk profile. Further, we feel that the recent developments at PNB are unlikely to impact the credit profile of the company. With this, we will now open the floor for question and answers. Thank you very much for being patient listeners.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have our first question from the line of Viral Shah from Credit Suisse. Please go ahead.
Hi, this is Sunil Tirumalai from Credit Suisse.
Hi.
Yes, congrats on continued strong growth. Just had a couple of questions. On the spreads, what's the outlook you have right now? I think last time you had kind of toned down your overall long-term outlook. I just wanted to get an updated thought on that.
Well, I'm feeling a little bit more confident, and I think between 200 to 200 basis points is very much doable, though we made about 236 basis points last year. I think liquidity will come in, and especially with the ECB getting opened up, one more avenue, it should ease the domestic market also. And hence, I'm confident that, we will be able to maintain our spread. And luckily, the large lenders before us also revised their reference rates in the vicinity of 20 to 25 bips, and we also followed without much, I would say, backlash from our existing customers. So I think it's doable now.
Got it. And, your numbers show that you are actually expanding into these smaller cities, and you also mentioned about smaller ticket size loans. How much of a yield, upside do you see from these?
Well, let me show you people. Yields are more related to products and segments rather than cities. So supposing if I was to move to a small city from where I come, which is Lucknow, I'm not going to pay 20 bits extra just because I'm now residing in Lucknow. But yes, if my profile changes, then yes, I will be ready. So I think, those are markets which are also matured and crowded, and they have very good profile of lenders and customers both. But geographically, yields are not very different pan-India.
Got it. And looking at your liabilities, the deposits, have been dropping as a share. What's the strategy around that? And any impact from the events at the parent on this?
Okay, good question. One is that that was deliberate, and our deposits are only second in cost to bank lines, right? Because there's a lot of administrative costs also included in deposit costs because these are retail in nature. Hence, we knowingly brought it down, and we do recognize the importance of deposits in our total borrowing mix, and we expect to. So it has one thing is it has grown over the last year by 16%, and today deposits are standing as of 31st March at 11,586 crores, vis-a-vis 9,987.09 crores last year. And we are, so it is not that we have lost confidence in the franchisee. It is not that there has been a run on our deposits. In fact, the month of February was the best deposit mobilization month for us, the month in which this event happened at the promoter's end. And the rating agencies have reconfirmed, and we are very confident that going forward we will maintain a mix of between 23 to 25% of deposits in our total borrowing mix.
Got it. That's helpful. And the last question is, how low do you see the Tier 1 ratio? Are you comfortable with before you raise capital again? Thank you.
Well, to be very frank, the board guidance is that at about 10 times lever to our Tier 1 capital, we should start preparing ourselves to raise additional capital or go to capital markets. And I think at about from a band of 11 to 12 times level of Tier 1 capital, we will be raising fresh capital, and I think that should come in our sort of forward journey somewhere in the last calendar quarter of 19 or the first calendar quarter of 2020. And let us not forget that internal accruals are going to be smart of this company since economy of scales are playing up. And I guess by that time our NOF should be somewhere in the vicinity of 8,000 crores when we go to the capital markets next.
Great. Thank you very much, sir.
Thanks.
The next question is from Ronak Raichuria from Asian Market Securities. Please go ahead.
Hello, sir.
Hello.
Congratulations on an amazing set of numbers, sir.
Thank you.
So my question was on the masala bond that you just discussed. So what was the quantum of the masala bond? Sir, has it been raised? Or
no, it has not been raised. We are in the process. So okay. we have registered a MTN of $1 billion. We have approval of $500 million from RBI. And I think the market size is generally anywhere between $250 to $300 million, and that is what our maiden tranche would look like.
Okay.
And 30% of it is already underwritten by IFC Washington to a maximum limit of $150 million on their own balance sheet.
Okay. So what rate would this be?
Well, everything, especially cost of funds, get related to the domestic cost of funds for the same tenure loan. Since it will be our maiden venture, 5-6 basis points I'm ready to leave on the table because after all we work in SEC A segment in all our products. We don't have the luxury of huge spreads. Hence, the first tranche can be 5-6 bits higher than the domestic for a corresponding period, but later on we are certainly going to do it at a lower price.
Okay.
So sorry to interrupt, Mr. Raichuria. May we request you to return to the queue for your follow-up questions as we have several participants waiting in the queue?
I'm not able to listen.
Just one question. Hello.
Okay.
Yeah.
Sir, the second one is on your sell-down strategy. Sir, because it's highly ROE accretive, so do we have a strategy as to a percentage of the loan book which should be sold down or something?
Yeah, very, very well said. So basically what we are trying to do is, since we are becoming a mature player, we would always like our pools to be rated and to be talked about in the external secondary market. And hence it will be in the vicinity of 8 to 10% of the AUM will be securitized.
Okay, that's it. Thank you, sir. I'll wait.
Have a nice evening.
Ladies and gentlemen, in order to ensure that the management is able to address queries from all the participants, you are requested to restrict your questions to 2 per participant. Next question is from Ayush Mohta from CD Equisearch. Please go ahead.
Good evening, sir.
Good evening.
So what was the nature of these loans sold through direct assignment route?
They are all type of loans. So they are basically retail loans. So they are, home loans, they are LAP loans, they are small LRDs, there are also PSL loans, and so basically retail loans.
So basically retail home loans, you're saying, right?
No, home loans, LAP loans, LRDs, FSME, PSL.
Mm-hmm.
So a plethora of product mix.
Okay. And so what's the rationale for selling these loans?
Well, it's to better manage the capital.
Is it because, the loan was stressed or something?
Well, then there will be no buyers. as one condition, let me just, share with you, they have to be at least seasoned for 12 months at least on our books. Second is that the buyers will not even take a single pick if there is a single delinquency at an account level. And just to explain to you, if our gross NPAs on portfolio is 0.33%, it is only 0.31 on the AUM because, it is always cherry-picked.
Right.
Stress accounts will not be sold through direct assignment, they will be sold through an ARC.
So, sir, have you sold any loans to ARCs yet?
No, none.
None.
And I really pray to God that day I don't see in my life.
Right. And so these loans which were sold through direct assignment route, so how much has been recovered?
What do you mean recovered?
Like,
it has been sold in the last quarter. So first main securitization we did of 3,000 crores in September of 2016. There about 2,200 crores is outstanding. So, that's the recovery that has been made in the last 18 months. And this is a fresh pool of 3,128 crores, which has been sold almost on the last day of the financial year. And that is why the current assets have sort of, bloated up on the last day to something like 4,035 crores.
Okay, so out of these fresh ones of 3,128 crores,
yes.
We do not have any recovery as of now. We just have a recovery of 2,200 crores. That is from September.
What do you mean by recoveries? I am not getting it.
Like if you are selling the amount of loans, are you getting the entire amount for it? Like if you are selling loans worth 3,128 crores.
Obviously. So in a direct sale, what happens? I get a servicing fee and I get a spread. And the loan EMI gets paid to PNB Housing. And then we transmit it to our buyers.
Okay, so the entire amount is...
Yeah, we are the recovery and the servicing agent on behalf of the buying institution.
Okay. And so, just last question.
Sorry
so why was
Ms. Mehta, may we request you to please return to the queue for a follow-up, please? Thank you.
Thank you so much.
Next question is from the line of Manish Ostwal from Nirmal Bang Securities. Please go ahead.
Yes, sir. Thank you for the opportunity and very good set of numbers, sir.
Thank you.
My question on the cost-to-income ratio, it has been steadily declining.
Can you speak a little, Ascender? Come close to your mic, please. I'm not able to hear you, Manish.
Yeah. My question on the cost-to-income ratio, sir.
Yeah?
It has been steadily declining from 30.87% FY15 to 19.54% FY18. Now, since we are growing very aggressively, so what is your outlook on whether the most of the efficiency are done or we can further see the improvement in the cost-to-income ratio? And secondly, what kind of AUM growth we can see in FY19 for PNB Housing?
I will split your question into two. One, I will talk on CIR, cost-to-income ratio. So one is that we are not growing aggressively. We are growing systematically. Right? And I think economies of scale have started giving its dividend. And in the next 8 quarters, I think our CIR will be somewhere around 16%. And so there is an opportunity or a headroom to further bring it down by 300 to 350 bits. And your second question is how big are we going to be in the next 12 months? Well, we don't give guidance on our growth rates, etc. But I can tell you we have the capability, capacity, sustainability to grow at about 1.7 to 1.75 times of the industry average.
Second question on this Masala bond, what kind of typical cost of borrowing, including exchange risk?
I answered that it is dynamic. Whenever you are borrowing, it depends on what the market is on that particular day or during that event. And as I said, yes, as a maiden tranche, we might be paying 5-6 bits over the corresponding bond market, domestic bond market, but not in tranche 2 or tranche 3.
last question on you did comment about anticipate liquidity tightness in the market. So what kind of, do you see the wholesale rates to move up sharply? What do you mean the tightness of liquidity? Can you throw some light on that?
Well, what I'm trying to say is that we are in annuity business and we require long-term funds. And from the last, let's say, 1 quarter, we are seeing a lot of volatility in the interest rate. So the issuers are not there and the subscribers are not there. And hence, long-term liquidity is an issue as of now. But I think with the coming sort of month and the opening up of ECB, etc., the government and the RBI will certainly do something to improve on it. And that is why I'm far more positive this quarter than I was in the last quarter. So I think it will ease out in the coming times.
Thank you, sir. Thank you very much.
Thank you. Have a nice evening.
Thank you. Next question is from the line of Mitesh Jain from Investec. Please go ahead.
Thanks, sir. This is Mitesh from Investec.
Yes.
I have 3 questions. The first is on OPEX to AUM. If you can give a guidance that what is the potential, like the guidance that is given in cost to income. Second, on provision for contingency, I've seen quite a bit of build-up in this year, FY18. What is our policy or internal policy of for provision for contingency? And thirdly, I noticed that the interest rate that we are offering on the individual housing loan segment, our floating rate is materially higher than the 1-year fixed rate that we are offering. So what is the thought process there, and what proportion of disbursement is coming from fixed loans?
I will just take one question at a time. The first one is obviously OPEX to ATA, which is a ratio, and it's a further refinement of CIR. So if the CIR will come down, certainly the OPEX to ATA will also come down. Today, our OPEX to ATA is in the vicinity of something like 68 basis points, and it has come down by 5 basis points over the last year. Now, I think in next 2 years' time, this should be in the vicinity of about 56 to 57 bits. If the CIR was to come down to, let's say, 16% or 16.5%. So that's the upside that we are going to get from OPEX to ATA. Your second question was on provision for contingencies. Now, provision for contingencies, we are a conservative set of management team. And what we do is that we have a policy that loans which are not NPA as on a quarter end, but has given us grief in the previous quarters. And by grief, I mean even repeated bounce or repeated delinquency or things like that. We provide against them and carry a contingency provision. Plus, to overcome cyclical aberrations of the future, we have a small pool. We have done contingency provision incrementally of 62.5 crores during the financial year that we are discussing. And I think going forward also, if our loans which are not NPA but has given us grief, we will have that sort of an elbow room to continue this good practice. And mind you, 100% tax is paid on this, so you can add it to your PAT, and there your ROTA improves tremendously, from 1.54 to about 1.62%. And, that is the type of, I would say, conservatism that we display in the way we manage our company. And your third question was floating. Why our floating rate is higher than fixed rate? Certainly because the 1-year floating fixed rate is matched with 1-year borrowing. Whereas when we do, floating rate, it is matched to a longer term, and hence 1-year fixed. And we like to insulate our individual customers from volatility in their daily life, and hence we offer a 1-year fix at a shade lower than, I would say, wing-to-wing floating rate.
So is it reasonable to expect that the share of fixed rate will be pretty high in incremental disbursements?
Well, the 1 year, I think, is what is going to be the USP of this organization. And we are very comfortable because we don't want... And why do we do it? Because if you see the last 6-7 months, there has been so much of volatility in the interest rates. We don't want, as a corporate, we can absorb it because we have a full-fledged treasury, right? But we don't want the individual, what a mortgage player is supposed to be doing, is to insulate the individual customer family from the volatility of affordability of an EMI. And that is what we are trying to do, if you ask me, culturally.
Thank you, sir. Thank you.
Thank you.
Thank you. Next question is from the line of Alpesh Mehta from Motilal Oswal Securities. Please go ahead.
Hi, good evening, sir, and congrats.
Hi, good evening, Alpesh.
Sir, one question on the repayment rate of the individual housing loan. It looks like it is upwards of 25%. Any comment on the same? And secondly, on the incremental borrowings, large part of the borrowings during the year has come from commercial papers. So strategy going forward?
Yeah, I mean, Kalpesh, you know, I will answer your second question first because you know that the bond market was not, I would say, conducive for long-term borrowing. And every housing finance company or NBFC has gone ahead and raised CPs. So this is more, I would say, market-dominated phenomena rather than our doing. Coming on the repayment rates, our repayment rates of all products are in line with the market. The total runoff on the book was at about 25%, which includes even the corporate book, which is at about 30-35%. So if you take individuals, that is in the vicinity of 18-19%, which is in line with the industry.
No, sir, if I look at your numbers,
which number?
It's a continuation of the same question, sir.
Which number are you looking at?
So the individual loan book at the end of last quarter was around 20, individual pure housing loan book, it's around 23,000 crores.
Yeah, because of the sell-off.
Yeah, but if, assuming out of 3,200 crores, even if we would have sold around 2,200 crores, something of that nature, right, because of the mix of everything. So end of this year, on the AUM basis, individual housing loan would have been around 34,000 crores, whereas we have disbursed almost 17,500 crores during the year on this product. So it works out to be upwards of 25%.
But it also includes the normal amortization to EMIs. 7-8% gets amortized through an EMI after 4-5 years.
Okay, so the 7-8% is the EMI related repayment and 17-18% is the normal prepayment plus some loan takeovers, is it?
The 13-14% is basically the prepayment, I would say, which will include balance transfer also. And about 7-8% will be the natural amortization.
Okay, got it. Thank you.
Yeah.
All the best.
Thank you very much. The next question is from the line of Dhaval Gada from Sundaram Mutual Fund. Please go ahead.
Hi, sir. Congrats on a good set of numbers.
Thank you.
Most of the questions have been answered. So just a couple of them. One, could you give the risk-weighted assets number for us? And second,
it's
could you
about
also...
80% of the portfolio.
Sorry, how much?
80.
80. Okay. Yeah. And could you also provide what's the incremental cost of borrowing for the fourth quarter and the incremental lending yields on individual housing, construction finance, and land?
Okay, I will give you that. Yeah. So, just a second, I have it. And the acquisition yield for quarter 4 for housing loans was 860. Construction finance 1186, non-home loan 1008. Okay? At the portfolio level, it comes to 9.53.
Perfect, sir. Thank you. All the best.
Thank you. Thanks.
Thank you. The next question is from the line of Mike Self from Alquity Investment Management. Please go ahead.
Thank you. Two questions. Firstly, could you comment on the competitive environment and whether you're seeing any further intensification over the quarter? And secondly, if your parents were to reduce their stake, is there a chance that your borrowing costs would rise as the ratings agencies would downgrade you through no fault of your own?
Okay. The first question was, we love our competition. It keeps us on our toes. It sharpens our skills. And just to give you a little bit of a flavor of the Indian market, the first 5 HFCs where we are also there still occupy 83% of the market share at a portfolio level. Incrementally, it is far higher, but that does not leave us complacent. And hence, we invest a lot in our people, in our processes, in our technology, so that our go-to-market strategy is far superior. Our turnaround times are further refined, and our customer service standards are far, far better than the customer expectations. So that is the first, I would say, reaction to competition. And incrementally speaking, in markets where we have gone in the last, let's say, 24 months, where we have opened brand new branches from, let's say, April of 2016 onwards, they have contributed about 30% business. And that shows that our strategies are working well, our brand is very well accepted, and our technologies and our people and our processes are responding well to new geographies. Coming back to PNB question, well, I'm not to comment on a shareholder's matter, but I will certainly like to give a little bit of a, I would say, throw light on the rating agencies, etc. And as I said in my commentary to start this conversation, the rating agencies were very, very positive when this event happened. And within a week, they did come up with their bulletins, which reconfirmed our ratings, and they very, I would say, explicitly mentioned that these type of events will have no impact on the operations and working of this company. So it was a point of inflection where they decoupled the two companies totally. And that's very positive. And just to say that our cost of, we have raised capital after that. We have raised the 1,500 crores for 10 years after that in the bond market. We were not priced differently prior or post the event. NHB, which is our regulator, repose confidence has given us again a 1,500 crores for 10 years. So I think the market has realized that the two entities, no doubt they have a common brand, but they work very differently. The management teams are different. The fungibility of operations is minimized, and hence there is no risk, operational risk or reputational risk between the two institutions.
Thank you, sir.
Thank you.
Thank you. The next question is from the line of Ritika Dua from Elara Capital. Please go ahead.
Thank you for the opportunity.
Hi, Ritika.
Hi, sir. So my apologies. Probably you've answered them, and I think I've probably missed your comments on two of these questions. So what were your remarks on spreads if that's already been asked? And so secondly, on the other OPEX, is there a one-off there? So that's it from my side.
Okay, so first thing is that I think, the liquidity is coming back in the market. There is some sort of a green shoot that we see there. And I think we will be able to maintain a healthy spread anywhere between 200 to 210 basis points. I'm confident because, we have also revised our reference rate by 25 basis points, and our customers have taken it well, both retail and wholesale customers, because the other lenders also reacted in a matured manner, and they did the same as we did, because last time that was my apprehension in Q3 earnings call. And coming to OPEX to ATA, I think our economies of scale are panning out. we should be in another 8 quarters get this figure of 68 bips to 88 down to about 56, 57 bips.
Sir, sorry, I just wanted to know if there is any one-off in the other OPEX this particular quarter.
Yeah. Can you repeat your question?
So I'm saying that is there any one-off in the, so in the other OPEX, other expenses component for this particular quarter?
Okay. So just a second. Other expenses that you are saying, why have they gone up in this
Yes,
quarter?
sir. Yes, sir.
Okay. There are 2-3 things which have contributed to this. And one is that when you securitize a portfolio, we amortize our COA and we also amortize our fee. Okay? Are you with me?
Yes, sir.
Now, the COA which was unamortized on the pool which was securitized was worth 20 crores. And the fees which was unamortized on the portfolio was 7 crores. So 13 crores came from there. Okay? Next.
Sure, sir.
Right? So that makes it to how much? 95 crores. Right? Are you with me?
Yes, sir.
So now comes about 25 crores. Yeah?
Yes, sir.
Out of that 25 crores, we did a marketing campaign which all of you enjoyed a lot.
Sure, sir.
Yeah, that costed 15 crores. Right? Now comes 10 crores. In that 10 crores, there are some HR provisions worth 4 to 5 crores that we are carrying forward for 18-19 because the company we knew is going to do flabbergastingly well. So we have to reward the team. So we have carried forward in the same financial year. So the remaining is 5 crores. Now this company has a lot of infrastructure, technology and for growth. And that capitalization always happens towards the end of quarter 3 or in quarter 4. So those costs also come in. And they are in the vicinity of 4 to 5 crores.
Thank you, sir. That's very helpful.
Are you convinced now?
Certainly, sir. So if I can just squeeze in along with the spread.
I'm not an accountant, that is why I asked you that.
Sorry, sir?
I'm not an accountant by profession, that is why I asked you.
No, sir, that's really helpful.
Thank you.
Thank
you so much.
Squeeze in with the spread.
Dua, may we request you to please return to the queue for your follow-up?
Sure, I'll return to the queue.
Thank you very much. The next question is from the line of Nishin Chawate from Kotak Securities. Please go ahead.
Yeah, hi. So what prompted you to sell loans in this quarter? And
better financial management and capital management prompted me.
Any specific numbers in terms of what rate you could securitize?
Well, we are getting a very smart spread and we are getting a very smart servicing fee. Much better than the industry averages.
Sure. And what would be the, on an outstanding basis, what would be the difference between the fees that are not yet amortized and the expenses that are...
Well, the cumulative difference is about 200 crores, and which all the companies will have to start doing as IFRS comes. So this is one company which is totally insulated.
So just to clarify on the regulatory front from next quarter onwards,
we are not very sure. Yes, there has been some one-page guideline from NHB, but we are going to represent because it says both the accounting standards on a single balance sheet have to be applied. I don't know how.
Sure. Just last 2 data points. What was the hike in non-housing part? You said that hike in housing part was 25 basis points.
What? Can you repeat it?
What was the rate hike that you have taken in non-housing
25 basis points across all segments, across all products.
Sure. And your current marginal cost of borrowings?
Well, the current marginal cost of borrowing is not a very true indicator because from last 2-3 months, the capital market long-term borrowings have been minuscule. So I will not say that you take that as a marginal cost of borrowing.
Great. Thank you very much and all the best.
Thanks a lot and wish you all the very best. Enjoy your evening.
Thank you. Next question is from the line of Bhaskar Basu from Jefferies. Please go ahead.
Yeah, good evening.
Good evening, sir.
Good evening. Just 2 questions. Firstly, on the salaried mix. So it seems that the salaried home loan mix has gone up from 66% last quarter to 68% this quarter. Any specific reason or shift in strategy?
No change in strategy. It is, as I keep saying, these mixes, we are a transparent organization. We are the only people who disclose it. Plus minus 2% at a portfolio level. Please give and take. It's large operations. Today your company processes 15,000 loan applications a month across the country in 21 hubs and 85 branches. Right? So these 1 or 2 percentage point aberrations quarter on quarter will keep on happening. Don't get worried.
And similar question on what is your target in terms of housing and non-housing / developer medium term? Okay. So again, plus minus 2% at a portfolio level, 60% housing, individual housing, 12% construction finance for residential units. So it makes it to about 72%. Yep.
Out of that 28%, about 15-16% LAP, loan against property. Right? So remaining is about 10%. Equally divide them between CTL, LRD, and NRPL, non-residential premises loan.
Okay. Thanks. That's all from my side.
Thank you.
Thank you. Next question is from the line of Nishant Shah from Macquarie. Please go ahead.
Hi, sir. Congrats on the great set of numbers. Very little.
Thanks.
Yeah. Hi. Yeah. So very little to complain on the micro. A couple of very macro questions about the industry. So first is this GST issue of applicability on securitization portfolio. So how has that affected the securitization market? Has there any clarification come through about the applicability on the principal amount or on the interest amount? And how is it affecting the pricing in this market? And second question would be on yeah, and okay. Second question, yeah, sorry, just
let us take a pause. So securitization has got two components. One is the interest payment. Interest payment will not attract GST because that's a repayment.
Sure.
Okay. On the servicing fee, there is a GST which is minuscule, right? Which we bear, and we even bear it on our passbook. And there is a credit input on that. So it's not top. What was now your second question going forward?
No. So just on the securitization bit a little bit more. The question I ask is because HDFC has been flagging off that there is some lack of clarity about the applicability of the GST, whether it's only to the servicing fee portion or to the entire amount. And that's why they've not been selling down loans to HDFC banks in the last couple of quarters. So I'm just trying to understand, if there is any gap for...
We have bifurcated it. One is repayment. Repayment, we are just working as an intermediary. Because it is a true sale. Right? So there is no service that we are rendering. Whereas on the service, there is a service fee which the buyer pays. On that, we pay GST right from the beginning. We are not disputing that. So that's it.
Achha. Okay, fair enough. And the second question is on a pickup in affordable launches by developers. So are you seeing any traction come through, especially in the southern states, for affordable?
See, I would say affordable housing you should treat as a mass housing. Because if you see 150 square meters of carpet area, 18 lakhs per annum disclosed income, that is not actually bottom of the pyramid customer.
Correct.
The next and 100 square meters, and below that is 6 lakhs and I think 90 square meters. So that is bread and butter of all housing finance companies. What? Out of that segment, if people qualify for PMS scheme, we send the data to National Housing Bank. We have got subsidies in the past for about 500 odd accounts worth about 20 crores. We have credited it into the accounts of our customers. So that's a business as usual. And as I said in my opening remarks, about 22% of our portfolio, incremental portfolio, is all about loans below 25 lakhs. So that one can say is affordable. Now, whether they qualify or they don't qualify for PMAY is dependent on their, I would say, their demographic details.
Fair enough. My question was more on the supply side. So are the developers getting into those, say, the smaller areas, the lower ticket size kind of projects?
Very good developers, creme developers have realized that this is the future. Right, and some of them are cherry-picked developers. They are all going, but those are large townships. They will take more than 10 years to get completed. But because of the income tax rebate, they are do it in 5 years, so they do it in phases.
Okay, thank you so much. That's it from me.
Thank you. Next question is from the line of Amit Gupta from IIFL. Please go ahead.
Hi, Amit.
Hi. So just I want to know, your tier 1 capital, tier 1 ratio is coming down. Your gearing ratio is also coming down. Theoretically, if your tier 1 is coming down, your leverage should go up.
That is why the gearing ratio came down.
So basically, if the tier 1 is coming down, your leverage should go up.
So leverage for the year has gone up, no?
It has come down.
See, okay. Now, look at the average gearing. Average gearing of 17 was 8.72 times. Average gearing of 18 is 7.6%. Right? And the portfolio has grown. Why this has happened is because the equity came in only end of November 2016. So the equity was only in our books for 4 months. Whereas the full equity advantage we have taken in the first year, which was my opening sentence of today's earning call.
Okay.
Right? That is why that has happened.
Okay, thank you.
Thank you.
Thank you. Next question is from Miyush Gandhi from Canara Robeco Mutual Fund. Please go ahead.
Hi, sir. Congratulations on a very good set of numbers. Is it possible to share disbursement market share in top 4-5 cities or AUM market share?
Okay, I will tell you one thing. Look, the first 10 cities across India contribute anywhere between 65 to 70% of the business at a market level. And so is the case with us also.
Okay.
And the remaining contribute 35 to 30%.
Okay. But, if I am not wrong, we used to, claim almost 10-12% market share for some of the cities, top 5-10 cities.
Yeah, we still have.
And in those cities, what would be our AUM market share? Is that a number that you can share?
No, that I will not like to share.
Okay.
I have those numbers, branch-wise, I will not share.
Fair enough. So just one last thing. Can you give some color on the network expansion that you plan over 19 in terms of employees, branches?
We will be opening 24 more branches in 17 new locations.
And these new locations will be outside of these top 10 cities? Is that...
New locations would mean mutually exclusive to the ones where we are present now.
Okay. Thanks a lot, sir.
Welcome.
Thank you. Next question is from the line of Koteshwar Rao, an individual investor. Please go ahead.
So with GST and RERA settling down, so can we say like...
So now can you request to speak a little bit louder? Your voice is... Maybe request you to speak a bit louder. Your voice is not audible.
Okay. Yeah. With the GST and RERA settling down, so I'm just asking whether housing as an industry can expect better industry growth averages than what we have seen in the last couple of years?
I really wish that, and I hope so. And I think this year is going to be better than the previous one.
Okay, that's good to hear. And the other thing, so the way PNB is quoting around 1.7 to 1.75 times of the industry growth rate. So are we good to maintain this kind of growth rate?
Yes, for the next we have built those capacities, Mr. Rao. So capacities don't only mean infrastructure. They are a combination of policies, SOPs, technology, network, people, go-to-market strategies, vendor management, a whole gamut of operations. We have that capacity. And that is why, our branches which we opened in 17-18, 24 in number, are going to really stand us in good stead. And also branches which we opened in 16, 17, 17, 18 are doing very well.
Okay, that's good to know, sir. So one last question. In the last concall, it was being told the ROA levels can be maintained from 1.7 to 1.85 by the time we come back to market for the capital infusion.
Yeah, so, give us the 8 quarters and we will be there.
Okay. Yeah.
See, it is also the way the management works. As I was saying, if I would have not done the contingency provisioning, my ROA is already 1.62%.
Okay.
But it is a conservatism that sort of makes us, do what we are doing. Because we don't want to be, totally going berserk and calling out great numbers, and tomorrow, because of cyclical aberrations or something, we have nothing to fall back upon.
Okay.
Thank you.
Okay, thank you, sir.
Next question is from the line of Rakesh Jain from Jasper Capital. Please go ahead.
Hello.
Hi, Rakesh. Good evening.
Good evening. Actually, I was just looking at the yields. Actually, for FY17, the yields were much higher than FY18. So, any particular reason for falling in the yields, basically?
Yeah, the market made them come down because the borrowing rates also came down. So, the yields came down from 10.76 to 10.07. But if you see, the borrowings came down much sharper from 8.55 to 7.71. And hence our spread expanded from 221 basis points to 236.
So any particular segment which basically witnessed the decrease in the yield?
It is not a segment, it is the market. It's the macro market.
Okay. And can I get your, basically the GNPA for construction finance and LAP?
Well, the GNPA for construction finance is still under 1 basis point.
Okay. And what about LAP?
LAP is far lower. Then, so I will just give you the numbers, sir. So, okay, at a company level, we have gross non-performing assets on the portfolio which is on our books.
Okay.
Right? 0.33%.
0.33%.
Yes. In housing loans, it is 0.35%.
Okay. And
just a second, sir, let me complete.
Yeah.
And in our non-housing portfolio, it is only 0.27%. And the combination of two brings it to 0.33%.
Okay, got you. And so just one more thing. What would be your amount that you receive for PMAY scheme, under the PMAY scheme? Subsidy?
PMAY, I think we have till now received, I will just give you the figure. We have received for 892 accounts 20.03 crores as subsidy.
Okay. Okay, sir. Thanks a lot.
Thanks.
Thank you. The next question is from the line of Piran Engineer from Motilal Oswal Securities. Please go ahead.
Yeah, hi sir. Congrats on the results.
Thank you.
I just had one question. Basically, over the last few quarters or couple of years, we've done a good job at reducing our OPEX ratio. But from here on, probably the improvement is limited. And on the other hand, we're seeing probably a 25-30 bip sort of compression in spread. So how exactly do we target ROE improvement? I get that the contingency provisions won't recur year after year, but that's only 10-12 bips of your, total loan book. So I'm really struggling to figure out how we will improve our ROA by 25-30 bips over the medium term.
Well, I think one is obviously, these compressions in spreads are not going to be permanent. This is a guidance only from quarter to quarter that I keep giving. And fortunately, I was proved wrong by God and the macroeconomic factors that the spread never got compressed the way I was projecting it to get compressed. And I hope God and the macro indicators remain the way they are. So, but I will still be conservative. On the second thing is that there are 2-3 elements in our operations which in the medium term are going to give me an upswing in my OPEX or CIR. One is that this growth agenda that we are carrying on our shoulders, I think 18-19 is going to be the last year in which such a phenomenal infrastructure, technology, people and geographical expansion is going to happen before we go to the capital markets once again. And that will bring my OPEX down by about 6-7 bips. Another 4-5 bips I think I'm going to get because our efficiencies are increasing. And hence we always say please look at our productivity indicators which we put up for the investor in the investor presentation. So that makes me a little sort of, I would say, sure that this figure in about 8 quarters should be around 56 to 55 bips to ATA. And I think this. So I think I have answered both on spread also and on the OPEX also. How it is going to happen.
Oh, okay. So that's all from my side. All the best.
I will just give you a figure, and that will really stun you people. Last year, which is 17-18, we opened our total go-to-market capacity of about 2 lakh square feet of office area. When I say office area, it is not only standalone haunted office area. It has people, it has network, it has SOPs, it has vendors, it has an entire ecosystem. In the year gone by, your company has added another lakh square feet of economically usable area. And that will give us an impetus and will be a catalyst for our future growth for this year and the next year. But this year also, in 18-19, we are going to repeat something like that. And then I think we are going to have a steady state of a business as usual expansion and not having this sort of a robust expansion plan. We will not require to have.
Understood, sir. Thank you so much for your time and all the best.
Thanks, and have a nice evening.
Thank you very much.
Any more questions?
The next question is from the line of Pawan Rathore from Anand Rathi. Please go ahead.
Good evening, sir. I'm sorry to have missed it out, but what proportion of the book is of home loans is affordable housing?
Yeah, 22% is below 25 lakhs.
22%. Certainly. Yeah. Do you wish to expand it?
See, as I said, we are not going to go berserk. We have 3S philosophy of doing business. Sensible, substantial, which means relevant, and sustainable. Right? With these 3 principles, we will keep on doing business.
Okay. Thank you.
Thank you. Good night.
Thank you very much. Ladies and gentlemen, that was our last question. I now hand the conference over to Ms. Deepika Padhi for the closing comments. Over to you.
Thank you everyone for joining us on the call. If you have any questions unanswered, please feel free to get in touch with Investor Relations. The transcript of this call will be uploaded on our website, that is www.pnbhousing.com. Thank you.
Thanks a lot. Good night.
Thank you very much.
Thank you for being with us. Thanks a lot.